Yeah, Chris, I got to tell you, I'm a pretty smart guy. And
Yeah,
so
you are.
in the mid 90s, when I started out as a financial advisor, because I knew I was a smart guy, I started doing my own research. And I found out that there were these companies called internet stocks that nobody wanted, but I was going to learn all about and start selling them to my clients. And what I learned pretty quickly is those internet stocks were starting to become popular. So I started putting my own money in the internet stocks, my clients' money in the internet stocks. If your listeners are of a certain age, they might remember names like Lycos and AOL.com and Yahoo.com. And Chris, I was so darn smart. I made more money trading stocks in my account than I did in my job as a financial advisor in the mid
And
to
you
late
sound
90s.
so 90s. I swear. Did you have like a cigarette? Did you have an ashtray on your desk?
No, I never. I never smoked, but you could smell the smoke in the bullpen from the
Yes.
generations of people behind me who had been in there
Yes.
smoking for
That was
sure.
more 80s. By the 90s, we were smarter by then.
Yes, yes. Well,
Right.
and remember, I was really smart because I was a genius. I was buying
You were very
internet
smart.
stocks and I
Yeah.
was making money. And then one day in late 1999, a truck driver came into my office. And my job at this time was to help people with building diversified portfolios and helping them make the right decisions for their retirement goals. And I had done well for this particular client. I noticed in my prep for the meeting, all of his portfolios were in line with where they should be. And he sat down and he said, "Jay, I'm going to have to fire you." And I said, "Oh, well, tell me why you're going to have to fire me." Because remember, Chris, I'm a genius. I was kind of shocked that
That's
he was
right.
going to
Yeah.
fire me. He
Why
reached
would anybody fire you?
he reached into his pocket and he pulled out a crumpled up newspaper article because it was still the 90s. Opened it up and he said, "This fund was up 89% last year. Why weren't you?" And he, of course, was showing me an article, if you're old enough to remember, the Munder NetNet fund. That fund only invested in internet stocks. That's where the real geniuses were, not myself. So he ended up leaving. Of course, we went through the
He
rest
really
of.
did fire you, didn't
He did. Oh yeah, took
he?
his
You would
money away.
absolutely get fired by not making 89% back then. Yeah.
And I'm pretty confident he moved it all into that Munder NetNet fund. Now, that was kind of a red flag, Chris, because, of course, I was a genius. I thought, man, that just doesn't seem right. And so I started doing some more research, and it turned out these internet stock thingies were overvalued. So I thought, well, since I'm so smart, I'm going to short these things. And sure enough, I shorted them at the beginning of 2000. And I saw those stocks that had helped me make more money than I did in my regular job go down. And for those who don't know, when you short a stock, what you're doing is selling it to somebody else. And as the price comes down, you can buy it back and make a profit. And boy, did I make a profit because, of course, Chris, I was a genius.
Yes.
At 27 or 28 years old, I had made just a lot of money compared to what I was earning in my job. Then as we rolled into 2001 and 2002, I slowly started getting back into the market as things started to get a little bit better. But I wasn't as quick as other people. I didn't think too much of it because I was a genius and I had already made two great market calls: buy internet stocks and short internet stocks. And then we roll through the first part of the decade, Chris, and I'm working for a company called Lehman Brothers. And Lehman Brothers was one of the bellwether investment banking firms and investment management companies. And so so this part of the story is really kind of disgusting. So in 2007, my role at Lehman Brothers was to be, one of the face people for some portfolio management teams. And we had a Fortune 500 client up in Arkansas. Every quarter we would go up. I would come up from Atlanta, Georgia as the face person, and I would talk about what had happened in the portfolio the previous quarter. And then the true geniuses from New York would fly down and they would talk about what was going to happen, their predictions of what would happen with their money that was allocated to these Lehman Brothers portfolios. So in the fall of 2007, I pick up the smart guy from New York. And so to make sure everybody's on the same page, that's one smart guy picking up another smart guy. And this guy says, "Jay, have you looked at the Lehman Brothers balance sheet lately? Have you looked at these derivative products that are on the financial statements?" I guess I really wasn't that smart, Chris. So I said, "Tell me about them. What do you think about them?" He said, "We can't understand."
Classic smart guy question. That was a classic smart guy. Yeah, tell me what you think. What do you think about it? Yeah,
right.
yeah,
right.
Classic smart guy question right there.
Yep.
Yes.
And this gentleman, who actually was really smart, he said, they scare the heck out of us. We can't figure out what they are. We're selling all of our Lehman Brothers stock, and we are raising a large percentage of our personal portfolios to cash. We're driving over to this meeting with this Fortune 500 company. I've got white knuckles on the steering wheel because I'm sitting there thinking there are going to be fireworks in this meeting. We get there, Chris. I do my part, and I talk about what had happened in the portfolio over the previous quarter. This gentleman says, we believe over the next 90 days, you're looking at shirt and hat size returns in your portfolio, meaning high single digits, low double digit returns. He said the exact opposite of what he had just said to me, what he was doing with his personal money not an hour before.
Yeah,
I got back on a plane.
That's the part of our industry we hated.
But remember, Chris, I'm a genius. So I was disgusted by that. I went back to Atlanta and I thought, well, I'm getting out of this market if he's getting out of this market. So I get out of the market. And then I start researching what all these derivative products are. And I think, I probably need to buy some gold. Can you look at some of the things that could happen here? So I load up the portfolio with some gold. And what happens? I sold my my big house, and we bought a smaller house because I'm a genius, Chris. I'm a genius. And so the market falls apart. I lose my job at Lehman Brothers. Luckily, not only was I out of the market, I was short the market because let's take a
sidebar here. This is where, if you need to know what happened now, go watch the movie The Big Short, and it'll tell you.
That's right.
Yes.
So,
yes.
I had been warning all of my friends at Lehman Brothers to sell their stock. And they all thought I was crazy because they had made a ton of money on the way up. I had been suggesting to my friends, hey, you might want to take some money out of the market. And of course, when everything fell apart, people call me because, Chris, I was the genius. I had figured out what was going on. And here's where I become less of a genius. And you use the behavioral finance term self-attribution. I had attributed all of my past success from picking internet stocks on the way up, just dumb luck. I was young and I understood what the internet was. Shorting them because I happen to have a front row view to people who were firing people like me, providing diversified portfolios and going all in on internet stocks. And then I had an inside view before the housing market and the financial crisis, because I had worked for Lehman Brothers, and it led me to believe I was smart. And here are the mistakes that were made after that. I didn't get back into the market because I thought I was smart, and I was looking through the lens of history. And I did not account for certain things happening in the economy and the financial system. I just stayed out of the market. And Chris, for those who don't remember, in 2009, 2008, every public company had to adhere to what they call GAAP accounting, generally accepted accounting principles. The Federal Reserve was prohibited from printing money. We call it quantitative easing now because it doesn't sound as bad.
It sounds good, but
So I was making decisions that I'm staying away from this. And then from the bottom of that market up, I missed all those returns because I thought I was the smart guy. And what do? They stop GAAP accounting regulations for companies. They start printing money. And the smart guy made the mistakes of not getting back in. And Chris, this is one of the reasons why your series on behavioral finance is important. People should understand biases and fears and how they can affect decisions that they make, and also lead them to believe that they're smarter than they actually are as it relates to investing. Now, I get kind of passionate telling that story because when I sit down with retail clients, I tell it in the way that I just did, to really set the stage to say that there are no smart guys. Nobody knows what's going to happen. And anybody who tells you they knows what's going to happen, you need to run away from them.
Run away. Absolutely.